Welcome back to our channel. We hope you'll find valuable content here. If you enjoy our channel, please remember to like, subscribe, and stay tuned for more. Let's dive in. Imagine the stock market as a giant puzzle. Each piece represents a company, and the picture it forms changes every day. Just like when you're trying to solve a jigsaw puzzle, there's no single way to predict exactly how the final picture will look. That's how professional stock investors see the stock market. Before buying a car, you'd probably do some research, right? You'd look at its features, check its history, and maybe even take it for a test drive. Similarly, stock investors do their homework before investing in a company. They dive deep into the company's details, like its financial health, the team running it, and its competition. They want to know if the company has a bright future ahead. The stock market, a giant, ever-changing puzzle. Imagine walking into a room filled with thousands of puzzles. Each puzzle represents a company, and every piece of it symbolizes different information about the company, its profits, losses, team, products, and so much more. Now, the interesting part is, these puzzles are always changing. New pieces are added, some are taken away, and some are swapped with pieces from other puzzles. This dynamic, ever-changing room of puzzles is what professional stock investors navigate through every day. In this vast room, investors don't randomly pick a puzzle to complete. They meticulously observe each one, trying to understand how the pieces fit together and what picture they might form in the future. They know that the image each puzzle is forming is influenced by various factors both from within the company and the outside world. For instance, imagine one of the puzzles is forming the image of a popular smartphone brand. The investors would look at the pieces that show the company's sales, its team, its upcoming products, and so on. But they also know that external factors, like a new competitor entering the market or global events affecting production, can change the puzzle's final image. So, they keep an eye on those aspects too. Investors understand that each puzzle, company, in the room, market, doesn't exist in isolation. The puzzles are interconnected. A change in one puzzle might affect several others. For example, if the puzzle of an oil company starts showing signs of struggle, it might impact the puzzles of various airlines, shipping companies, and manufacturing firms due to rising fuel costs. In this complex scenario, investors don't get overwhelmed. They embrace the uncertainty and navigate through it with research, analysis, and strategic planning. They might not be able to predict the exact outcome, but by understanding the various pieces and how they interact, they can make educated guesses and informed decisions. The research detective unraveling the mystery of companies. Imagine you're a detective, and you've been handed a mysterious case to solve. The case isn't about finding a missing person or solving a crime, but rather about understanding a company inside out. This is the role of a stock investor when they dive deep into researching a company. Every company has a story, and to understand this story, investors play the role of detectives. They gather clues, connect the dots, and try to predict the next chapter in the company's journey. The clues in the financial statements. Financial statements are like the diary of a company. They reveal the company's financial health, its profits and losses, debts, and assets. By reading and analyzing these statements, investors get a clear picture of how the company has been performing. It's like reading the previous chapters of a book to understand the current plot. The strength of the team. A company is not just about numbers, it's about people. The management team, the leaders, and the employees play a crucial role in the success or failure of a company. Investors look at the track record of the management team, their past successes and failures. It's like understanding the main characters in a story to predict their next move. The competitive landscape. No company operates in isolation. There are competitors, market trends, and external factors that influence its journey. Investors study the competitive landscape to understand the challenges and opportunities the company might face. It's like understanding the setting and environment of a story. The future prospects. While the past and present are essential, investors are also keenly interested in the company's future. They look at the company's plans, upcoming products, innovations, and strategies. They try to predict how these factors will shape the company's future. It's like trying to guess the ending of a story based on the current plot. The big picture: understanding the world around the company. Imagine you're watching a movie, and you're engrossed in the story of the main character. But to truly understand the story, you also need to be aware of the world around the character, the setting, the events happening in the background, and how they influence the protagonist's journey. Similarly, when investors look at a company, they don't just focus on the company itself. They also pay attention to the broader environment in which the company operates. The economic climate. The economy's health plays a significant role in determining a company's success. When the economy is booming, people have more money to spend, which can benefit businesses. But during economic downturns, companies might face challenges. Investors keep a close eye on indicators like interest rates, inflation, and unemployment rates to gauge the economic climate. Political landscape. Politics can have a direct impact on businesses. Changes in government policies, trade agreements, and international relations can either benefit or harm a company. For instance, a new tax policy might increase a company's expenses, while a trade agreement could open up new markets for them. Investors stay updated with political news and events to anticipate their potential impact on their investments. Global events. In today's interconnected world, an event in one part of the globe can influence markets worldwide. Natural disasters, pandemics, technological breakthroughs, or even cultural phenomena can shape market trends. Investors remain vigilant about global events and analyze their potential ripple effects on the companies they invest in. Industry trends. Every industry goes through cycles of growth, stagnation, and sometimes decline. By understanding these cycles and the latest trends in a company's industry, investors can make more informed decisions. For example, the rise of streaming services impacted the traditional cable TV industry. Investors who foresaw this trend could make strategic moves accordingly. Spotting patterns: the art of technical analysis. Imagine you're at the beach, watching the waves crash onto the shore. Over time, you start to notice a pattern: after every 3 small waves, there's a big one. By observing this pattern, you can predict when the next big wave will come. This is similar to what investors do with technical analysis. They study past stock prices and trading volumes to identify patterns and predict future price movements. The history on the chart. Stock prices move up and down every day, and these movements are plotted on a chart. Over time, this chart tells a story of the stock's journey. By looking at this historical data, investors can see how the stock reacted to certain events or conditions in the past. Recognizing patterns. Just like the waves at the beach, stock prices often move in patterns. These patterns can be simple, like a stock consistently rising after a particular event, or more complex, like a series of ups and downs that signal a future price movement. Some common patterns investors look for include head and shoulders, double tops, and flags. Indicators and tools. Investors use various tools and indicators to help them analyze stock charts. These can include moving averages, which show the average stock price over a specific period, or the relative strength index, RSI, which indicates whether a stock might be overbought or oversold. These tools provide additional insights and help investors make more informed decisions. The limitations. While technical analysis can be a powerful tool, it's not foolproof. Just like predicting the exact size and timing of the next big wave at the beach can be tricky, predicting stock prices with absolute certainty is impossible. Technical analysis provides clues and probabilities, not guarantees. The safety net: risk management in investing. Imagine you're a trapeze artist, soaring high above the ground, performing breathtaking stunts. While the audience is captivated by your daring feats, they might not notice the safety net below, ready to catch you if you fall. In the world of investing, risk management is that safety net. It's the strategies and precautions investors take to protect their investments from significant losses. Understanding the risks. Before you can manage risks, you need to understand them. Different investments come with different types of risks. For instance, stocks might be affected by company performance and market trends, while bonds might be influenced by interest rate changes. By understanding these risks, investors can make more informed decisions. Diversification. Don't put all your eggs in one basket. One of the fundamental principles of risk management is diversification. Instead of investing all their money in one stock or sector, investors spread their investments across various assets. This way, if one investment performs poorly, others might do well, balancing out the overall portfolio performance. Setting stop-loss orders. A stop-loss order is a tool investors use to limit potential losses. It's like setting a safety threshold. If a stock's price falls to a certain level, the stop-loss order automatically sells the stock, preventing further losses. Regular portfolio review. The investment world is dynamic, with market conditions changing regularly. To ensure their risk management strategies are still effective, investors regularly review their portfolios. They assess their asset allocation, check the performance of individual investments, and make necessary adjustments. Emotional discipline. One of the biggest challenges in investing is not letting emotions drive decisions. Fear and greed can lead to rash decisions, like selling a stock too soon or holding onto it for too long. By maintaining emotional discipline, investors can stick to their strategies and avoid impulsive actions. The investment philosophy: crafting your own path. Imagine you're embarking on a grand journey. You have a map in hand, but there are numerous paths to reach your destination. Some paths are short but risky, while others are longer but safer. The path you choose depends on your comfort, your willingness to face challenges, and your desired pace. Similarly, in the investment world, your investment philosophy is the path you choose. It's a set of beliefs and principles that guide your investment decisions. Defining your goals. Your destination in the investment journey is your financial goal. It could be buying a house, securing your retirement, or funding your child's education. Clearly defined goals will help you choose the right investment path and stay focused during the journey. Understanding your risk tolerance. Just like choosing a path based on your comfort and willingness to face challenges, understanding your risk tolerance is crucial in shaping your investment philosophy. It determines how much risk you're willing to take and guides your investment choices. Choosing your investment style. Your investment style is like your traveling pace and method. Some investors prefer a passive approach, investing in index funds and letting the market do the work. Others might choose an active approach, constantly buying and selling stocks to outperform the market. Your investment style should align with your risk tolerance and financial goals. Ethical and social considerations. Sometimes, the journey is not just about reaching the destination but also about how you get there. Ethical and social considerations involve investing in companies that align with your moral and social values, ensuring that your investment journey is also socially responsible. Continuous learning and adaptation. The investment world, like the world itself, is constantly changing. Continuous learning and adaptation involve staying updated with market trends, adapting your strategies to changing conditions, and being willing to learn and evolve. The long game: the power of compound interest. Imagine planting a tree in your backyard. In the initial years, it's just a tiny sapling, growing slowly. But as time goes on, its growth rate accelerates. Not only does the tree grow taller, but its branches spread out, and each branch sprouts new branches. This is similar to how compound interest works in the world of investing. Your investments might start small, but over time, they can grow exponentially, thanks to the power of compounding. The magic of compounding. Compound interest is often referred to as the eighth wonder of the world. It's the process where interest is calculated on the initial principal, which also includes all the accumulated interest from previous periods. In simpler terms, it's interest on interest. Starting early. The earlier you start investing, the more time your money has to compound. Even if you start with a small amount, given enough time, it can grow into a substantial sum. It's like giving your tree more years to grow and spread its branches. Consistent contributions. Consistency is key when it comes to benefiting from compound interest. Regularly adding to your investments, even if it's a small amount, can lead to significant growth over time. It's like watering your tree consistently, ensuring it continues to thrive. Reinvesting returns. One of the critical aspects of compounding is reinvesting the returns you earn. Instead of taking out the interest or dividends, you reinvest them, allowing your investment to grow even faster. It's like the new branches on your tree sprouting their own branches. The impact of time. The longer your investments compound, the more significant the growth. The difference in growth between compounding for 10 years versus 20 years can be substantial. Time truly is an investor's best friend when it comes to compounding. The emotional roller coaster, navigating market volatility. Imagine you're on a roller coaster. As it starts, you feel the excitement building up. The ride takes you up to great heights, giving you a momentary feeling of euphoria. But soon after, it plunges down, and your stomach churns with anxiety. The stock market can be a lot like this roller coaster, filled with ups and downs. How investors react to these market fluctuations can significantly impact their investment outcomes. The peaks and valleys. The stock market is inherently volatile. Prices of stocks rise and fall based on a myriad of factors, from company performance to global events. These fluctuations, both the highs, peaks, and lows, valleys, are a natural part of the investment journey. Emotional responses. Humans are emotional beings, and it's natural to feel elated when the market is up and anxious when it's down. However, making investment decisions based on emotions can lead to poor outcomes. Panic selling during a market downturn or getting overly greedy during a market upswing can be detrimental. Staying the course. One of the keys to successful investing is having a long-term perspective and staying the course, even during turbulent times. It's about keeping your eyes on the end goal and not getting swayed by short-term market movements. Seeking expert guidance. For many, navigating the emotional roller coaster of the stock market can be challenging. Seeking guidance from financial experts or advisors can provide a balanced perspective and help investors make informed decisions. The importance of a plan. Having a well-thought-out investment plan can act as a guiding light during volatile times. It provides clarity on investment goals, risk tolerance, and strategies, ensuring that investors don't make impulsive decisions. The Investor's Toolkit: Essential Resources for Success. Imagine you're a chef preparing a gourmet meal. To create a culinary masterpiece, you need the right tools, from sharp knives to the perfect pan. Similarly, in the world of investing, having the right resources and tools can make all the difference in achieving financial success. Research platforms. In the digital age, investors have access to a plethora of online platforms that provide in-depth analysis, real-time stock quotes, and expert opinions. Platforms like Bloomberg, Morningstar, and Yahoo Finance offer valuable insights that can guide investment decisions. Financial news. Staying updated with the latest financial news is crucial. Events around the world, from political elections to economic policies, can influence market movements. Subscribing to financial news outlets like the Wall Street Journal, Financial Times, or CNBC can keep investors informed. Investment books. Books offer timeless wisdom. Classics like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel provide foundational knowledge that every investor can benefit from. Financial advisors. While self-research is valuable, seeking expert guidance can offer a different perspective. Financial advisors, with their expertise and experience, can provide tailored advice, helping investors navigate complex financial landscapes. Investment apps. With the rise of technology, several investment apps have emerged, allowing investors to track their portfolios, set budget goals, or even automate their investments. Apps like Robinhood, Acorns, and Mint provide a blend of convenience and functionality. The Investment Odyssey: A Recap and Way Forward. Investing is a journey, filled with challenges, learnings, and opportunities. Throughout this guide, we've explored the intricacies of the stock market, from understanding the mindset of professional investors to navigating market volatility. We've delved into the power of compound interest and the importance of crafting a personalized investment philosophy. Key takeaways. The stock market's complexity. Professional investors view the stock market as a multifaceted entity, using various tools and techniques to make informed decisions. Technical analysis. Recognizing patterns and using technical indicators can provide insights into potential future price movements. Risk management. Protecting investments through diversification, stop-loss orders, and emotional discipline is crucial for long-term success. Investment philosophy. Crafting a unique path, understanding risks, and staying true to one's goals can lead to fruitful outcomes. Market volatility. Emotions can sway investment decisions. Staying the course and focusing on long-term objectives can help navigate the market's ups and downs. Essential resources. Leveraging research platforms, staying updated with financial news, reading investment books, seeking expert advice, and using investment apps can empower investors on their journey. The way forward. Investing is a continuous learning process. As the world evolves, so do market dynamics. Staying curious, being adaptable, and always striving for knowledge will ensure that investors are well equipped to face the future's challenges and opportunities.